Morning, everybody. It's Tuesday, November 13th, just after 10 o'clock here on the West Coast. Dr. K and I are actually here in the office trading off the beach in Playa del Rey. So Dr. K back in town after trotting around the globe. Anyways, we're looking at this morning. You see some action based on some comments made this morning by the Goldman Sachs CEO, Lord Blankenfein, or whatever his name is, saying that Congress will probably come up with a deal for the fiscal cliff. I want to make sure everybody can hear me. Everybody hear me okay? Yes, okay. There's a couple of people getting no audio. That's their problem. You probably want to shut that off over there too, Dr. K. Dr. K is trying to run me off his laptop over here, so we're getting a little bit of an echo. We're going to clear that up. Sorry about that. Anyways, looking at what's going on in the market here, we can see that you got the NASDAQ well down below the 200-day moving average, and we're trying to rally this morning on these comments that there's going to be some sort of a deal cut as far as the fiscal cliff goes. And I think that you've got to be wary of comments. I think that this is going to get stretched out a little bit, and that the Democrats are going to try to gain as much political capital from it as they can. So I don't expect that they're going to roll over right away in the next few days, announce some great deal, given the fact that the Democrats seem to be pushing this idea that they have a mandate to raise taxes on the rich, which they can, but I have news for them. The rich can actually take a lot of different maneuvers to avoid paying those taxes. But anyways, or just limiting your income. It's another. There's a lot of strategies. I'm well aware of them. Being one of those people, and you don't have if you don't have to make $500,000 a year to support a heavy-duty lifestyle, then I think you can just take methods and strategies, tax strategies that help to mitigate it. And I think it's not the rich that get hurt. I think it's the average person who gets hurt, who depends on a strong economy for their job, and all those kids coming out of college, 50% of them who can't find jobs. And it's not clear to me that just simply either solving the fiscal cliff or letting us go over the fiscal cliff is going to make any of that better. So I think that may be the issue for the market long term. Dr. K, you want to chime in here with your thoughts on the market currently?
Well, we're in a nice little downtrend here. Of course, we're pivotal in terms of potentially being oversold. Well, we are oversold, so some people are expecting a bounce. So far today, this bounce is pretty anemic, and the S&P is hovering right at its 50-day, just like the NASDAQ did earlier. When you knock on a major area of support a number of times, it increases the odds of moving through that area of support with force, much as the NASDAQ did. So I think the odds at this juncture probably tilt toward a continuation of the downtrend. We might need to see some sort of capitulation in the market before we actually do get a bona fide bounce.
Bona fide? I always say bona fide, but that's, I guess maybe I got a little Freudian hang up there. But in any case, you can see the S&P trying to hug the 200-day moving average. And we thought, it could do something like the NASDAQ hang out here for a few days. But I'm going to guess that you're going to see some news flow that doesn't necessarily lead to a rally in the market right now, and you are vulnerable to further downside. So we're just kind of watching this. And on the short side, playing it on a stock-by-stock basis. Some of the stocks that we have been looking at, I'm going to clean up my screen here. So you can see clearly on the index charts, you're in a downtrend. And let me get rid of all this garbage here. And we'll throw up, we're going to go with a big, fat 5-minute chart here. We'll throw a weekly up here. And a daily up here on the left side, like that. So you can see I got Michael Kors on here. I consider this stock to be a late-stage failed base, and it's not that late stage. It's really second stage. You might consider that going back to here, that maybe this was a flag formation. Maybe that was the first stage, so 1, 2, 3. If you're the type of person who likes to count bases, speaking for myself, I don't really get into that. I just watch the action of the stock and figure out which way it's going to move next if I can. And so in this case, I think you have a heavy volume breach of the 50-day, which is always the first sign of a failed breakout. It tries to make a high and then it fails at the 50-day. Now notice also last week and earlier this week, it undercut the lows along the bottom of the base here. Hopefully you can see that. along the bottom here. You can see it undercutting the lows, so that sets up a logical rally. On earnings this morning, that took the stock right up near the 52 or 50-week, 50-day moving average. Boy, am I slow today? I must be being down at the beach, or that's probably what's causing it. But in any case, you got heavy volume. Stock's still trading up. It shows a red bar on my, because I kind of combine the sort of a candlestick feature in that I will color code the bars based on where the stock is trading relative to its open. And that just tells me if something is rallying weakly or reversing hard or just kind of holding tight with where it opened up. And sometimes that's helpful on an intraday basis. But I thought Coors was probably shortable there on that basis. I didn't really use shorting it up here and it started to roll over on the MACD cross, so I figured, it's not going to get much further than here. I got a quick stop at the 50-day moving average, which is at right here, 53.86. So I figured, coming up to 52.50, I'm going to come in and hit some. And if I get a sell signal on the 620 set up here, the 6-period moving average and the 20-period moving average, so we call it a 620. Just for short, the 5-minute chart that I use intraday, you can see you have the break here, so you could hit it again. You had a rally here, and now it's starting to break again. It's trying to turn here, so we'll see what happens. I do think this is weak, and I think it's prone to testing the 200-day moving average, so we'll just have to see how this pans out. The other thing that you could see here would potentially be more rallies up into the 50-day moving average, and it may take 2 or 3 or 4 more days possibly, but I think a lot of that will be keyed to what's going on with the general markets. You have to remain very cognizant of where you are with the general markets, and we know that the S&P sitting on the 200-day isn't a logical place to bounce. Okay, so we know that. So we're just watching for that. You don't necessarily have to react to it right away. And if I think the S&P bounces from here, you're also going to see the NASDAQ bounce, even though the NASDAQ is kind of in no man's land. Far below its 200-day moving average, but at this point I would be looking for the S&P to find support and drag the other indexes up with it, given that it is in a logical position to bounce. That doesn't mean that short sale ideas don't work. We talked about this morning. Baidu we thought was shortable using the 10-day moving average, now at 104.47 as a logical guide for a stop, because if it's going to break out, it's breaking out to the downside. And you're heading for this low now, so you're through this 100 level. So I don't know if you're going to undercut this briefly and then do one little blip up to the upside before you roll over again. But we'll just have to see how that plays out. But with the breakdown here, you're not really getting any rally, and now you're starting to break out to the downside. And it's continuing lower. You can see here on the 620 chart that it's just continuing lower and there's no real turn. So being short this, I want to watch for that turn, may take intraday profits, because it isn't a logical place to bounce. And I think you guys probably have been, for those of you who've been using this little simple method of mine, and it is very simple, and like I said, it's not some holy grail. It just happens to be something that works very well given the way the market's banding, as Dr. K likes to say, at the current time. And so that means it basically seems to fit the action. At some point it may stop working. And there are some days when you don't really get any good signals. But you can see here, Baidu had broken down before the opening and has continued lower, so it's really not turning yet. The one I'm keeping my eye on here very closely is Apple, and you can see it's tried to pull in. It's tried to give you a sell signal here, but it's holding. But I tend to see Apple mainly right now as just holding in a little flag pattern. And it's not clear to me whether it can necessarily rally out of this flag pattern and head for the 200-day. That would be logical, and that's something that you have to watch out for. So, I've got one eye over my shoulder watching these, and I'm holding a core short position in Apple, but we get a 620 sell signal today. At some point, I may be short, several thousand shares and trying to hit it for a big gain. A couple things I do note on this chart is you'll notice that the volume is diminishing as you move higher throughout the day. So I think you're in a vulnerable position here. So I'd be watching this very closely, and we'll see that. We'll see whether throughout the course of this webinar today that maybe we'll see the thing roll through here in the next few minutes. So other stocks I think are shorter. We talked about in our morning, what do we call it, Dr. K? You call it the pre-market pulse? Yes. Sometimes the market doesn't have much of a pulse, so I don't know what you would call it in that case. The pre-market flatline report. I'm watching TripAdvisor. Trip got a nice blip the other day when Priceline announced that they're buying Kayak, and it had announced earnings, gapped up, and then it rolls back in, immediately violates the gap up day low, and comes in, finds support at the 50-day. Now it's heading up to the 200-day moving average. I think one could probe this up in here using either the high of yesterday, which is 35.89, as your quick stop, but if you can hang out to the 200-day in this area up here, it could just get up that high. As I see it, you've got a big head and shoulders forming here. Let's make it even bigger. Somebody says the audio sounds like Hawking's drunk, Stephen Hawking's. Dr. K, can you do an imitation of Dr. Stephen Hawking's synthetic voice? So I'm assuming everybody can see, somebody can only see a NASDAQ chart, but I'm assuming everybody can see the chart of Coors on the week, or TripAdvisor on the weekly here, and you can see this big ugly head and shoulders. I'm going to say this is your left shoulder, big head, remember the big break. Off the peak defines the right side of the head, and you've got 1, 2, and this is your third right shoulder, and I would say you have pretty good odds of this perhaps failing. So I'm willing to take a probe here and see how it acts. You're watching Apple now. Is that no? That's Trip. You can see that you're getting a 620 sell signal intraday. So you could short it right in here, and we actually have ourselves this morning on this signal a little while ago, and it's starting to break down, so that might be worthwhile. So that's something you watch for, and this is a good way using this method. And like I said, you might come up with something on your own. I think that you can devise something that's going to keep you in the ball game. And what I like to do, since I want to short into a rally on TripAdvisor, I'll come in every day and watch for this, and then once you see it, you can come in and short it. If it starts to reverse and break down, then it's going to work. Otherwise, if it keeps rallying, it's going to stop you out, and you can just flip and go the other way. So anyways, you can see we're getting, market's getting a little bit of a rally here. We're up 47 on the Dow. NASDAQ's still down on the day, and that's being led lower probably by Baidu, which is getting hit. And what else? It seems like it's almost mostly Baidu, but you're not really getting any rally. Google's off a couple of bucks. You're not really getting any rally in these stocks. I mean, even though Apple's up $5, it's all up less than 1%. So somebody says, "Welcome back to welcome back to Playa del Rey, Dr. K." That rhymes. Anyways, okay. So where are we? Other stocks we're looking at. Google, for example, has been breaking down, and you got this little downside breakout from the flag formation, which we were looking for, and you did get a bounce off the top of the base here. You can see that here's the top of the base running around, well, right around these lows here at 650 or so. And we haven't gotten to the 200-day yet, and so I'm wondering whether we are. So I'll actually come in on this bounce, and given that this is resistance right around 670 or so, I think you can come in and test it. You'll also notice that we did get a 620 sell signal on Google a little while ago, and it is starting to work on the downside if anybody's shorted on that basis. Priceline is another one we've been keeping an eye on because of the gap up type of thing. You got to rally up in here. Notice this morning it gapped up into the 200-day moving average right here, and now you got the 620 sell signal on the 5-minute chart, and you see it rolling over. And so that's where you can come in and short the stock, and if it turns in, and at this point actually you would get a cover signal or a buy signal probably lower than where you came in short. So I think that's, this is really the system I devised for shorting stocks into rallies, and then also covering stocks when they turn. And and excuse me, I'll adhere to this depending on a couple of factors. What my initial entry is on the stock. If I'm got a huge profit, and I'll give it a little bit more room. But you can see, for example, let's look at, I think yesterday was a pretty good example. Yeah, you can see Apple yesterday morning. We open up here, and just for the opening, you get a sell signal here. You break down, now there's your cover point. You roll up, and you get a sell signal, then a buy signal, then a sell signal, then another buy signal, and then it really goes nowhere until the close. And one thing you might notice about this is usually your first 1 or 2 signals are your better signals during the day, especially in a sort of a chop and slop environment like today. And I think that I'm thinking this stock is probably, Priceline, for example, I think this one's probably going to going to head lower from here. I think the long-term pattern is really just this big rolling top. You know, you might think setting up. We'll see. I mean, but the beauty here is I think if you're going to short it, you can use the 200-day or the 40-week moving average. So. I don't see any questions up there yet. Does anybody have any questions yet? If you do, start piling them in so we can start putting them together in a little list here. Let's see. Any other stocks I'm looking at here? We looked at Baidu. Baidu's looking pretty weak. LinkedIn is one I'm keeping an eye on. And you can see you're getting a rally here, so we're keeping an eye on this. But you'll notice on the 620 chart, you got a buy signal here, so it's really not ready yet. And it may, I'd watch it as it's coming up to the 200-day moving average, because I think if we do roll over in the market, I think this thing's definitely going to go lower. If you look at the weekly chart here, this could be starting to turn into a couple of left shoulders and a big head, although you don't have the heavy volume, so it's more of a rolling type of head and shoulders. The best ones, the poster children for head and shoulders tops, you know, things like, we looked at this last week, HLF, Herbalife. And you can see here's a nice big fat head and shoulders, big break on the right side of the head, a couple of right shoulders. There's 1, 2, 3, 4, 5, if you want to count them that way. I would probably count 1, 2, but it doesn't really matter how many you want to count. You can see that this morning Herbalife had the rally up, and there's the rollover and the break below. You know, a little bit of a buy signal here. I don't know if you would react to it right away necessarily. But it's starting to break down, and it's possible this may be ready to head a fair bit lower. If I was shorting it in here, I would keep a pretty tight stop, probably about either this high, well, I would say 48.05 max at the 10-day moving average, because there is a potential if the market rallies. Let's say they announce, let's say by some, you know, great fortunate circumstance, Congress, all the parties come to some agreement on the fiscal cliff, then I think you might bring some rally on. So let's say that happens in the next day or two. That could theoretically take some of these stocks into the 50-day moving average. And remember, that's what you're guarding against the whole time with using this sort of system like I'm using. Like I said, you can create your own. You can mess around. Dr. K saw some of this, and then he's back-tested it and come up with his own system that's more attuned to his style of trading and his psychology. But for a madman short sale artist like me, this works pretty well, and I found that it works pretty well. And I think a few of you who've been using it have been emailing me and telling me that it is working pretty well. So it's good to hear it, but keep in mind there may come a time when it doesn't work so well anymore. And when that happens, that's when you have to change up your tactics. But for now, that seems to be working. I'm just checking the market here, and I do that from time to time as well. Dr. K's model probably is better at picking off the index ETFs in terms of sell and buy signal, but you see it's been chopping around. My guess is it's going to roll back, and we're going to head lower by the close. That's just the way the market feels to me right now, barring some sort of big news out of Washington, which I don't see happening because, as I said, we tend to think that the Democrats will try and drag this out and get as much political capital out of it as they can. You agree with that, Dr. K?
One more time?
Do you think the Congress is going to come to an agreement on the fiscal cliff very quickly?
I think that it's going to, at best, be at the 11th hour. Just enough so that the market can get right on its edge, as nervous as possible, creating a volatile situation and therefore intraday profitability potential. Mm-hmm. But because the Dems can screw it all up, and it is actually very possible they might not come to an agreement, and that we will go over this fiscal cliff after the new year. It's looking potentially increasingly likely as we move closer to the end of this year that may happen. And that's why the markets simply are telegraphing that they're nervous, and we are in a downtrend, a continuation of the downtrend, even though we're oversold, and we're not getting that bounce.
Yeah, and oversold can become a lot more oversold, especially in this environment where things are really hanging by a thread, wouldn't you say?
Yeah, you can see it in all leading stocks. There really isn't too much respite for the market at this juncture. So again, the odds seem to favor a continuation of this downtrend, potentially uninterrupted by any sort of bear market rally.
Yeah, and so that's why I've continued to focus on the short side, mainly because it has been working. And utilizing my little system here, my little 620 chart, which, yeah, they're both exponential moving average, someone is asking. That's why it has a little E up here. You can see up here a little E. And again, I encourage you, if you're using this, if it may not fit your trading style. You find that it doesn't really fit yours, right, Dr. K?
Well, no, it does fit mine. I think it's viable. It's statistically viable. I backtested it. I can see it working in real time. However, I have my own. It's a short-term style that is targeted on the volatility indicators that I use also in conjunction with my longer-term UVXY model on selfish investing.
Yeah.
And that's just there's a rule. You don't want to be scattering your fire and having your attention and your focus going in 5 different directions at once. It can hamper your trading. So I've elected to trade volatility indicators and focus on the UVXY model as opposed to getting distracted by the potential that I can make money in stocks. My profit potential in these UVXY type instruments, I think, is comparable. So I'm going to just stay focused on that instead of looking at individual stocks. But both systems are viable.
Somebody's asking, why did the UVXY model reverse yesterday if we're in a downtrend?
The overall downtrend is intact. However, the model reversed because it spotted the potential for
market rally?
Yes, a simple market rally that could go for a day or two. Now, you'll notice that UVXY is incredibly volatile, and what I've noticed is the model can be pretty good at picking off those 1 or 2 day rallies, and you're sitting on a 10% or 15% profit in UVXY. So that's why the UVXY model simply does switch more frequently than the market direction model.
Okay, so let's see. Let's go through some questions here. I think I've given you guys a pretty good overview of what I'm looking at on the short side. Remember, the way I've talked about this, I only focus on a handful of really choice names, I think, and I'll add a couple here and there as we move through a weak market. And of course, Coors is now added to my list, and I'm short it from this morning, above 52. And that's one of the newer ones. But so, the bottom line is you really don't need more than, say, 5 to 10 short sale targets. The fewer the better. The more liquid the better. So I don't really get too complex. I know a lot of people will run a lot of different short sale ideas, and we'll go through those in just a second. They'll run a lot of ideas like that by me, and a lot of them are valid. And I think if you're comfortable and you know a stock pretty well, let's say Herbalife isn't one stock that I've been shorting myself, but I know some people who have, and they've been making money shorting it, and they understand the whole story and everything behind it. So that helps. That can help give you better conviction. So a certain stock might be more suited for someone else, not necessarily myself, and vice versa as well. So shorting is a very tricky beast to deal with and to tame, and a lot of it has to do with understanding what your biggest weaknesses are. And so, really for me, getting hacked up in March, April of 2009 was a great lesson because it's forced me to. And the market's like that, it'll if you have even small weaknesses, it'll magnify them and make them a lot bigger. And I think that was glaring in 2009 for me, and it's helped me create these systems that help me keep risk under control. And I have to say that they've worked pretty well so far. And I think a lot of you have just seen that since we started talking about this in these webinars. Let's see, any others? I'm going to go through some ideas people have and just start covering those. Let's see here. Home Depot, people are asking about. I think Home Depot was up this morning, but I'm not going to buy any stocks in this environment. And I think the whole housing thing is a little bit ephemeral and something of an illusory type of hope and change, I guess, for the housing industry. Because yesterday we saw D.H. Horton get smacked after announcing earnings. We've seen Toll Brothers get smacked, and Lumber Liquidators coming down to the 50 days. It's getting some support, but I'm very wary of any of this, and I certainly would not be going long any of these. Now, someone asked if Toll Brothers is a short, and I'm not going to short it here in this position. I would rather it were closer to the 50-day. But this is a $32 stock, $31 stock. Let's take a look at it on a weekly chart. It's kind of rolling over, but it's not that classic pattern we're looking for. I think there are better targets. And really, the way I look at the housing move and the move in the housing sector, they're really the dogs barking, and that's been happening over the last month or two, right? And so I think a lot of that has been, in fact, you can see in here, you know, Toll Brothers has had a nice jack during August, September, and that was right into the top of the market. And I think in a lot of cases, when you look at these patterns on a long-term basis, let's just make this weekly chart of Toll Brothers a lot bigger. Let's see if I can shrink it down so we can see longer term. You know, it's still in this big pattern. It's kind of this big cup now, and it's still way off of its highs back from 2005, and so it's got a lot of that to come. So it's really like this big pod formation extending over the last several years. And I don't think that this tells you anything more than the fact that the market was being led for a couple of months there by a lot of dogs barking, and it's pretty much that simple. Watch it here. You can see you're getting a little sell signal. I'm watching Apple. I just want to keep an eye on this because I'm ready to go ballistic on this thing. Where the 6 period is 546.99, the 20 is 546.83. And I know Bill, my trader, is watching this closely as well, so just be ready to hit that button, Billy, when we see that break. So we'll see if that happens live action here on our webinar. You know, and I got to tell you guys also, I've been trying to get Dr. K to talk more, but you know, he's always very selective with his words. We're kind of opposites. You know, I'm pretty much a mealy-mouthed fool, and I like to just babble on, whereas Dr. K is a little more measured. But I think one person emailed in that they were tired of listening to me, and you know what? I got to tell you, sometimes I'm tired of listening to me, but not today. Dr. K is like, yeah, sure.
I'll be the one.
Hey, but all I have to say is I think if you've been paying attention these last 2 or 3 weeks, and I divulged this little system just to give you some insight into how I work things out, I think it's worked pretty well for people. So, you know, if you have to put up with my crap and my babbling to get that, then I hope it's at least worth it in some small way, I guess. Anyways, whatever. But it was refreshing though to have somebody email that they're tired of listening to me. And I said, yeah, I agree. Let's get Dr. K up here to talk more. Anyways, let's see. We're going through some more questions here.
Come to Vegas. I'll be talking all day.
Yeah, in fact, I'm going to let him talk all day. I'm just going to go hang out at the bar down the hallway. Sherman Williams, what do I think about it? I'm not a buyer. Yeah, I know it's up today. They're buying some Brazilian or some South American company that makes paint as well. So I'm not really a buyer. And that's not really a pocket pivot. Well, it's not a pocket pivot because it's not higher than this downside volume. So it's really just kind of straight up, straight down. And for all you know, this could turn out to be a little top here. So I'm not really that enamored with it. And like I said, we're not buying anything on the long side. We think the situation with the long side just continues to deteriorate. And that tells us that you're not even really in a position, well, you could get a follow-through, and it must be an index-type rally. And it might even be playable, you know, using the TQQQ or what are the other, the UPRO, which is a 3X S&P long ETF. I mean, it might be playable using this system, too, because you'll notice that sometimes you can get, you know, a sell signal here early in the day right at the opening. You could have bought since it's on the SPXU, which is the Ultra Pro short, it's a 3X, 3 times short ETF, you could have gone long the market, so that would look like this on the UPRO. Let's turn it around, and you can see here's your buy signal. So you actually could have played this, and then once you get the sell signal, you know, you're out. And wham, bam, thank you, ma'am. You take your few points out of the stock and be happy for the day. You know, it's right now this acts like a really great day trading system. And like I was joking last week, I might go get a job with some proprietary day trading firm. Of course, that will be the time when this thing stops working. But for now, it's working. So that's all I have to say about that. As Forrest Gump might say. Now, Monsanto, somebody's asking if that's a short. It's not in position. You can see, though, it's starting to set up. You're getting this little head and shoulders type action here. And this rally coming up into resistance is, I guess you could try to short it here. You might be a little bit late to the party because sometimes these things can break down, and they'll look like they're going to break down, and they're really undercutting these lows. And what happens? You get another rally up into the the 10-week moving average or the 50-day moving average on this daily chart. So if you did short it, now let's just look at how we could have approached it here. You don't have an intraday sell signal. You got one here, but it was quickly negated, and now you're watching this and may roll over again. I still think for my money, I like today I like Trip and I like Coors, and I'm short those. And just putting out the Trip, we're not making any money on it. We're just kind of probing it right here, but the Coors we are, and it's coming in pretty nicely. It's a little squirrely during the day though. So you got to account for that. But I've been playing the stock for a long time, and I'm very familiar with the way it acts, at least from the long side, which has now morphed into the short side. Somebody asked, is Expedia a short? And I think this is a good question. I would not short it because there's no rationale for doing so. However, on an intraday basis, you had one short sale signal, I don't know what's going on here, yeah, yesterday, that you could have shorted and then covered at the end of the day. And then this morning you got a buy signal turns into a short signal, and I guess you could be day trading it on that basis. But if we look at the daily chart here, you're just trying to break out, and it's holding up. So that's not a weak pattern. But if it did break down, it might coincide with weakness in Trip, which is in the same group, or with weakness in Priceline. And I think whoops, where'd that B coming from? I think these two are in better positions to short, given that they're in weak patterns and that they're close to their 200-day moving averages, okay? I hope that makes sense. Starbucks, somebody wondering about that? Somebody sent me a picture the other day of a Starbucks van that had pulled over and they're unloading coffee at a coffee shop, a coffee place, a Starbucks coffee shop, I guess. And the door on the van they pulled the door back, and so it has star B on the door, and then the rest of it is on the side panel of the van is the UCKS. And so the way that they pushed the door over it, it said it had the logo of Starbucks and then sucks, and I thought that was pretty funny. I gotta find that photo. Maybe I'll show it to you guys next time. But Starbucks is a doggy-looking stock. It tends to be this big. I don't know, Dr. K, would you short Starbucks? Let's drag you in here.
Well, we've got a move back up through.
Or would you buy it?
It's major area of resistance. So I mean, it's an interesting question because you've got a gap up, but in context of the chart, it's a defective gap up. It's as we have discussed in our presentations, Bible gap ups have to be high quality, just like pocket pivots, and that certainly is not a high quality gap up simply because it was preceded by a gap down.
So yeah, and some gap downs there, like Trip is that way, Priceline is that way, and Starbucks is. So all these are kind of similar. So
there's a lot of volatility, I think, that's going to happen because you've got a lot of tug of war. But I think ultimately this thing is shortable. It's certainly not worth going long. I would be taking a short position in this as well. It's very close to that tipping point, really, because first of all, it's undercut the low of the gap up, and it looks to me like it wants to roll back over. And in a weak market environment like the one we're in, I think it'll have no problem doing that.
Yeah, so it becomes a matter of when the market starts going down, you can pretty much throw darts at the IBD stock chart or stock quote pages and find something that's going to go down. Keep an eye on Apple here. We are starting to get a little bit of a breakdown, and there it goes. Just barely hanging on. I'm showing 54699, 547 versus 54685 on the 20 period. So if this is where it's going to break down, it's going to break down. And on this particular case, sometimes I might just go ahead and short it, figuring that if it gets to this 548 high, then I can just run away. But the market, you can see we're only up 19 points on the Dow. The NASDAQ is getting weaker at minus 4.48, with the NDX even weaker at minus 5.43, down 0.21%. It's not like the nightly business report. But you can see the market's weakening here, so I think you see Apple go, the market's going to get even weaker. So we're just keeping an eye on that. And let's go through some more questions here. Somebody says, I live in Las Vegas and we'll see you guys. Great. Yeah, come and say hi, definitely. Travel safely. We generally try to. Lulu is, I think, something to keep an eye on. They're coming out with earnings not until December, so you're safe on that regard. It's rallying today, And I think you can only really short it on rallies up towards this level, up towards 71.72 near the 50-day. It is a big cup with handle that has failed, so it is in play as a short sale target. It's one of the stocks I've been watching. It trades a couple million shares a day, so it's liquid enough, but on a price point basis, I've noticed it's a little bit squirrely. So I veer towards the big stocks, the one-click gratification type situations. But that's what I've been doing with Lulu right now. And somebody asked, would you consider going long on any housing-related stocks? No, not at all. Not when you're seeing D.H. Horton and other builders start to break down. And I think a lot of that stuff, those are the dogs barking. Lumber Liquidators, Home Depot, those have been the better stocks, but I think they'll get dragged down with the rest of the group. Short XHB, looks like it's rolling over. Any comments? Well, we did talk about the other builders, but XHB, it's finding some support at the 50-day. So to me, these aren't really the big leaders, and I'm more interested in shorting the big leaders and not necessarily some of these dog-ear stocks, or even going after housing-related, because I think it's sort of a latecomer and hasn't had as big a move as, say, something like Coors or Apple or Trip. And the patterns are much weaker there in those stocks than they are in the builders. A lot of them look like this, so it's still premature. Regarding the negative news for Germany right after the election, are we in for more bearish activity? Would that be in Europe or just announcements or news coming out of Europe? Dr. K, your comments? In terms of, you've got all the printing of money going on in Europe, a continuation of that, and you've got countries that are deeply in debt. So you still have a lot of instability in Europe, and you have a lot of Europe in recession. UK is in recession, and so the picture's pretty bleak. It's not any better. It's not getting any better, and all this money printing that goes on is just injecting the patient with more morphine while the patient's really suffering from a brain tumor. So, I'm not real optimistic on the future of these debtor countries, U.S., U.K., and Europe. So we'll just have to watch the market until the market will guide where we should put our money as we go forward in all of this. But it doesn't make any sense to try to predict when the next crisis is going to happen in Europe. They will have another crisis, and they'll step in and they'll print more money, and it's going to be like that kind of give and take for the foreseeable future. Yeah, and probably the U.S. as well. So what does that mean then for the precious metals? Well, that's good for the precious metals. I think we're going to see skyrocketing gold and silver, perhaps like we did in the 70s, late 70s. And I wouldn't be surprised to see, gold double from here and silver go up, 4x or more. Yeah. This gold-silver ratio is historically it's at quite a low level. So I think that the price of silver really needs to catch up so that this historical ratio can get more in line with what it's been over the last 100 years. So I think that bodes very well for silver over gold in terms of investment momentum. Yeah. And what we're looking at here on both the metals, we'll just use GLD as an example here. You can see we come down to the 200-day, and it holds the 200-day moving average, the red moving average, and then you do get this sort of pocket pivot-like action here, but you're extended from the 200-day. You're really kind of in no man's land. You're coming up through the 10-day, but it's kind of V-shaped, and so we don't really want to come in and play this. If this downtrend here, this is occurring too quickly after this downtrend, so you'd want to see this kind of set up, and what we'd be watching for is maybe a little tight sideways action, and maybe some announcement regarding the fiscal cliff implies more money printing, and so you might see some sort of buy sell at that point. But at this point, you're underneath the 50-day here, you're above the 200-day by a pretty good margin, but the 10-day is really the moving average to keep a close eye on for some sort of pocket pivot as they move tight sideways. And you see that so far they are, and you're seeing the volume kind of drop down. I look at the nearest contract, nearest futures contract on gold, for example, and you can see a similar pattern to the GLD and holding in pretty tight, not a lot of selling in here. So that actually looks like it's trying to consolidate this low here, this pullback, and try to set up again. But you just got to be patient, let it play out. You don't want to force it. I know it's fun to bottom fish on gold, but I don't necessarily think that you're going to be rewarded right away. I still think there's a lot of variables in play right there. Somebody says the indexes on a weekly chart don't look as chaotic as they looked in the past two corrections. Would you consider this relevant to where we go from here, Dr. K? What do you think of that?
No, I don't think that's something you should really be weighing in. I think far more important really is what the price volume action is telling you in terms of these indices and leading stocks. You don't want to let your focus wander into areas that are less relevant.
Yeah, I'd agree with you there. Is there some kind of structural problem with the UVXY? The 52-week high is $1,500. Is there an underlying bias in this ETF?
Well, it has reverse. UVXY has reverse splits. There's no structural problem. When the price of UVXY gets to a certain level, usually under $10, then they often will do a reverse split. That applies to all ETFs, including things like TZA, which is the 3x inverse financials. If you pull up those charts, you'll see that these instruments have done reverse splits. Sometimes the reverse split is done on the basis of 10 to 1. And so, of course, the natural high price of the stock will get inflated by that factor.
Okay. Somebody's asking what the settings are here. On the MACD, it's 6, 20, 10, C. So that's what there's not, it basically mimics a lot of what you see here. Sometimes it confirms it, sometimes it doesn't. I like to see the two moving together. So, and I would say, you probably could even use slight variations of these settings. You could use a 5 and an 18, or a 7 and a 22 or something. I bet you would come up with similar signals. So like I said, it's not some holy grail. It's just a very simple system. Nothing really fancy. And it evolves. It changes with the market as well. Fossil is a stock that looks pretty doggy. And you're underneath this arrow of support. You got so now this should be resistance. So rallying up into this level right here, which is pretty much coincides with the high around 82.44 on Fossil, is probably your area to be shorting the stock if you want to short it. It does have this ugly look, and it's these two big head and shoulders merged together, so like Siamese head and shoulders formation here. You got one head here, another head here. They're connected at the shoulders here. And this looks like it's starting to break down. So I would love to see a rally up into the 50-day moving average would be a great place to short the stock. But if you did here, you would definitely want to use a tight stop near the high of today, somewhere around there. So, but it looks like it wants to break down, and you see more and more of these patterns. So, we can even look at, for example, Apple and its pattern on the weekly chart. And you can see the fact that it's broken down for the first time, really broken down below the 40-week or 200-day moving average here. But you can also see that you got a left shoulder and you got a head, and you're coming down to the neckline. So I could see generally the weakest patterns will tilt a little bit. So I could see an undercut through these lows. It's kind of what I'm watching for. I think that's ultimately where it goes before you get a real big bounce that might even take you above the 200-day moving average or the 40-week. And at the same time, I want to be guarding against a snap rally up to the 200-day. And that would coincide with the right shoulder. So it's going to happen at one point, but my thinking is that it's probably going to happen a little bit lower below this low so that you get a downward sloping or a descending neckline on the pattern. And I think that may be the critical mass for the stock there in terms of undercutting this low first before you see some kind of rally. But you never know for sure, right? And so you have to have some mechanism that's going to keep you out of trouble. And we can see on the daily chart, you can see it's rallying above the 548 level. It's run into resistance here. But really, on the daily chart, all you're doing is hanging out in this little range here, which is sort of an inverted bear flag. So we'll just see how this pans out by the end of the day, but I'm keeping an eye on it. Let's see. More questions? Oh, I don't want to buy HD. I want to short it. I wouldn't short. Yeah, I guess if you want to short the breakout, you got a way to do that, but I don't think you have real huge odds of the stock blowing apart. It's not like it's had a decent move, but it tends to be slow, but I'd wait for it to break down. That'd be my style. So I can't tell you what, myself, I would not short it. If you wanted to try and short it using the high of today or something as a stop, then be my guess. I'm not clear to me that you might make any progress on that sort of a trade. Go after the weak stocks. Go after the stocks that have been broken down and are under distribution. For all you know, institutions are going to hide in Home Depot as the rest of the market blows apart. And the best way to determine whether a stock is under distribution is whether you see some, massive volume breaks in the stock or reversals like we're seeing, say, in Coors, or Apple coming down on huge volume all the way down. And that's got to be one of the ugliest parabolic downtrends I've seen in a long time. So it looks pretty nasty. So that's the stuff you want to go after. Bodies in motion. Remember, things that are in a downtrend will tend to continue in a downtrend. So, Dr. K, here's one for you. Dr. K mentioned last week that he enters 12 to 18 positions at the start of a rally. How does he chop down to fewer positions? To my knowledge, he doesn't.
No, right? In practice, and this goes all the way back to 1991, what I found was my signature style of trade hasn't really changed too much in a good market environment. So in other words, if I find myself with, say, 13 to 16 positions in a strong market, and the reason I do that is because I find it psychologically difficult to leave behind a stock I know is going to go higher. So I want that stock in my portfolio to some measure. And I'll be 200% invested in such an environment. And when one of those, say, 15 positions starts to underperform, and that might not take very long. It might be on the order of a few days. I'll cut the position in half or sell it out entirely to make room for a new stock that I think is going to outperform that particular stock. So, if you will, the dynamics of the market, let's say we get a follow-through day and we get some buy signals in various strong stocks. I find myself with 8 positions, and these positions might represent 200% of my portfolio. So then what I'll do is I'll cut back on the weakest position by half or whole, and that makes room for a new stock. So in practice, the dynamics are that those 8 positions will eventually increase to maybe 13 to 16 positions in my portfolio. And that also speaks to the viability and enduring nature of trends that we saw in the 90s and in 2003 as well. We haven't really seen those sorts of trends since then. The longest one was a 3-monther in late 2006, from August, September, October, basically. That was the longest nice, reasonable trend we've seen in the market that was playable among many names. So, that's 6 years ago. So this environment has been absolutely brutal and challenging, and that's where, the stuff of great ideas is born. It's just because you've got to survive in these kinds of environments. And that's how the pocket pivot and viable gap up concept came to be in 2005, and now the Crossbow 620 shorter term models are thriving in this environment. And so you just got to wiggle whatever the market serves. You got to take it as it comes and stay on the cutting edge. So in other words, it's all to say there's no get rich quick. It's never easy. You got to keep on your toes, and you got to stay focused.
Yeah, and always trying to push your own envelope, I suppose. Someone asked this question: could you give us some insight why we should buy your new book? Will there be some significant differences from your first book? Well, first of all, if you don't buy it, our mothers are going to be very angry with you. And I should point out that Chris's mom, Eiko Mom, as I call her, she actually worked on the Japanese translation, which just came out. We have actually copies of that, and that's pretty neat to see it. Also coming out in German, I think, Chinese, Korean, and Spanish. So we're pleased with that. But the new book, obviously we're not going to just rewrite the same book. And the whole point of the book, and we have talked about it before, but we may have some newcomers out there to the webinars. The whole point of the book was, excuse me, to take all of the input, all of the questions, all of the comments that have come to us from people who read our first book and who also are members of our website. And what we've tried to do is take all of those and address them directly in the book in terms of giving answers, a broad range of answers, and dealing with some of these topics that come up frequently among the people that follow us and send us a lot of questions and feedback. So it's basically, the book is dedicated to the subscribers of Virtuous Selfish Investing and people who've read our books, because they're really the ones who provided the seed for the whole concept, and essentially more or less a workbook. We have some chapters where we directly address some of the more practical issues of trading, where we get into more practical issues of psychology and ways to keep yourself out of various traps. And there are a number of exercises in the book, and hopefully some of that inspires you to question your own motives for trading, question your own psychology, understand who you are, because I think ultimately that's the great thing about the markets, is they expose your weaknesses as a human being, and you can improve yourself by paying attention to what the market's teaching you. And so a lot of that's in there, and a lot of exercises so that you can train your eye to see the things that we've become very accustomed to seeing, as well as some trading simulations in detail in the book. And we deliberately picked some examples that aren't so dry, clean cut, or what cut and dry is what I'm trying to say. And even better, and I think this is the primary reason to buy this book, is that it's going to be in full color, and the charts are going to be in full color. And to my knowledge, I've never seen another investment book published in full color. So
well, it's also multimedia, which is exploiting the use of existing technologies in a book format, so that when you actually see our examples, it helps your eye acclimate
to train your eye, basically, yeah.
Because that's, I think, a very important key. I spent years and years, really the 90s, sizing and resizing charts to train my eye as to what base looks proper. I didn't want the x-axis or y-axis to impinge on my judgment of the quality of the chart. And I can't impress upon everyone the importance of that. I've seen way too many experienced traders get fooled by compressed charts, thinking the base is tight, or x-axis might be elongated, and that leads them to think the base is loose. I mean, these are very simple concepts, but they can, and especially when you have money in the line and you've got to figure out whether you want to pull the trigger, it can spell the difference between execution of the trade and failure to execute.
Yeah. Somebody asked the question, when you trade intraday, are there any specific market internals you look at? Not really. I just watch my little chart ski there and just kind of go on that. I do keep an eye on where the markets are trading in terms of their overall position, and that can be a factor sometimes. So let's see. We won't have copies with us in Las Vegas because it doesn't come out until January.
We got the word now. I think they're going to have copies available on the 17th of December.
Oh, okay, so a little earlier than we originally thought.
Darling's doing a good job.
Great. Somebody asking, is LE forming the right shoulder? I wouldn't short this stock because it only trades about 750,000 shares a day, so it's a real light trader. I'm not really into that, and I would be wary of trying to play with that. It's very volatile. So is it a right shoulder? You could say it is, but you got some big volume support here, and maybe you could short it on a rally up in here, but it's a little squirrely, so it's not really my preferred shorting situation. So could Panera be in for a short rally? It's not really one that has hit my radar screen, to tell you the truth. I don't know. I just see a stock on the weekly chart building a base here, so I don't see no real heavy volume on the second break. So it's not, it's holding above. This is the breakout here as far as I'm concerned. So you broke out through this base at the top here, and you've run up, tested that, and now you're into the 50-day, but it doesn't really seem to be getting any downside velocity. So not really on my list of stocks to go after. So run through a few more of these. CMG is a short. I mean, that was an optimal short up here, or even breaking down through the 50-day moving average. But I think since then, it is it's kind of flopping its way down there. We talked about it last week about shorting it right up here because you were up into this 280 resistance level along these lows, and so that was logical. It made sense there. But I don't think that it's really a high probability short at this point. So I'd rather be coming after some of these newer ideas that I'm looking at. So that I talked about. And you're getting these. Some of these are rallying a little bit more, like the Trip. I'm watching this coming up, and you're not really getting much volume on that. So it's, to me, still in play. We're still trying to see where it goes. You can even see Apple is coming up. It's still in this inverted bear flag, and I don't think you're seeing heavy volume here today. So let me see. What are we looking at on Apple's volume today? Minus 6%, so there's nothing huge there. It's pushing that 550 level now, so we'll just kind of see where it goes from there. But that could turn out to be short-term resistance, and we'll just have to see how that works out. But meanwhile, you can just go by this, and you can see you haven't really had a clear sell short signal yet. You had a buy signal early in the day, and I guess you could have stayed with that. Let's see, more questions. J.C. Penney under distribution. Well, it has been for quite a while, so, and it's down and dirty, but I haven't really, this is a weekly chart of J.C. Penney. It's not a big leader. You can see, it has broken down, but I'm not really interested in shorting. I'd rather be short cores, to tell you the truth. So it's the weaker sister here. So let's see. With the market weak, what stocks are holding up well? Maybe the next leaders when the market heads back up. I don't see any. So, Dr. K, right? I mean, do you see anything you want to buy here, or if the market turns, it's something you're going to run into?
Not at this juncture, no.
Yeah. So we don't see anything. And we don't know. We can't tell you where the next leadership is. That's why I'm skeptical of any market rally and would view it ultimately as a shortable rally. Let's see. Oh, here's one from Dave Eccles, our buddy. How's it going, Dave? Dr. K, how has the performance of the UVXY model been since you made the changes, and how many signals has it given?
It's been 4 signals, and so far 4 for 4. You can go to the results page on the website, and you can see the actual UVXY table in its performance since the most recent adjustment, which was took place over the summer.
What would be the maximum? Uh-oh. I just went and sorted these accidentally. What would be the maximum percent position you would take?
In what?
In your 12 to 18 positions. What would be the maximum percentage?
Well, I generally had a rule that I wouldn't take any more than a 25% position, but that's in a strong market environment. Now, if you look at more recent years, you might only have a small handful of leaders leading the way, in which case I haven't sat with 15 positions since 2006. That was the last time I had that many positions. So what you have to do is you have to focus your capital on the few names that are doing well, and that means you've got to use position sizing techniques to pyramid yourself into the position as it continues to prove itself. And of course, pocket pivots come in very handy because it allows you to buy a stock a number of times on the way up.
Okay. Let's see. Just scrolling through here. Somebody's asking about Amazon. And Amazon's right above the 200-day, the 40-week here. So I'm not really going to short this here. This isn't really one of my targets yet. I haven't seen enough of a breakdown. It hasn't been that favorite of a stock. So I don't really consider it something that I would necessarily go after on the short side. Amazon's a weird stock too because even though the earnings have been weak, you have not seen the stock, break down for a long time. It's had this huge PE or infinite PE because they keep losing money, and so it's kind of a weird situation. So I just kind of steer clear of it. Let's see. Any other last questions here before we wrap it up? Somebody else saying, if we see any other stocks like Apple that just continue to trend down, and would you expect to see left shoulders to develop? I haven't seen any others. Whatever I'm looking at, I've pretty much covered in this webinar. And again, we're just kind of watching this, and we'll probe on the short side here and see how some of these pan out. Today Coors has worked pretty well. You're not really seeing any short signal in Apple yet. It continues to just move higher, and it's getting right up to this 550 level. So we'll just have to see how this plays out. And just checking for some last questions. Gil, do you have a mother? I do have a mother. I was not born from a test tube. Lily looking stronger. Lily looking stronger. I don't know. I'm not buying Lily. It's a dog. It's a dog with fleas. Maybe next time you will let Dr. K sit at the big table with the microphone. I tried to get him to sit here with the microphone, and he has not wanted to do it. He fears
I like the
microphones.
kids' table. It's a
Yeah, he
lot
stays
easier
at
for
his.
me.
He likes his desk by the window. Anyways, let's see. I'm just kind of
Works for the kid
cruising
in me.
through here. I think that's pretty much it. So, you know, you guys kind of see where I'm at. Keep an eye on Apple here for some kind of a turn. Google, I think, is still underneath, and so that's been working so far as a short. And Coors is still, well, it's trying to come out of here, so we'll just kind of see. But you know, so far it's come off the peak decently. We'll just kind of see how things pan out going into the close, and that's pretty much it. So, you know, hopefully you guys get an idea what we're looking at. And hopefully, you know, some of these things you've been working yourself using this little system or your own variation of it, however that works for you, and doing okay. So I know I've gotten some emails from people using it, and it even got them out of Coors, I guess, the other day when it jacked to the upside and failed, and I think it might have been this day here when it jacked to the upside and they blew out and the thing rolled over. That's pretty much it. So anyways, thanks for showing up again, you guys. We'll be back at you next week, and we hope to see some of you this Friday when we are in Las Vegas. And I might point out that this is going to be our last Traders Expo Money Show, we've decided, mainly because we're burnt out on the whole concept. I mean, I like writing, I like speaking. I'd rather do webinars, and we'll probably do more webinars and things like that rather than going to the Money Show. I tend to find that the Money Show is more geared towards, you know, guys who are in their 70s or 80s who want to buy mining companies and oil production companies. There's a lot of booths for that kind of stuff, and so we'd rather be focusing maybe on something that's more direct presentations to our base, and that means all you guys. So anyways, so on that note, with Dr. K, we're going to get some lunch pretty soon, right?
Sounds good to me.
We'll catch you guys next time.
See you in Vegas.
All right,
For
take
those who are
care.
coming. Take care.
Ciao.